Hello, my name is Richard Murphy and I'm from Tax Research UK, and I want to talk about something which seems to be becoming increasingly important in UK taxation and also in the taxation affairs of the UK's Crown dependencies, that is Jersey, Guernsey and the Isle of Man. And that something I want to talk about is called territorial taxation for corporation tax. Corporation tax, of course, only applies to the affairs of companies. It does not apply to ordinary people, living people. Territorial taxation is a new development in UK taxation. We really don't know much about it to date, but it is something that the new Conservative Liberal Democrat coalition government is extremely keen to promote. What it basically means is that companies which are resident in the UK, and a company is resident in the UK if it was incorporated in one of the 4 constituent countries of the United Kingdom, or if its central management of control is here, then those companies will only be taxed upon their income arising inside those 4 member countries of the United Kingdom. And basically the income that they have which arises from outside the United Kingdom will, if the Conservatives have their way, avoid taxation in this country. Now that is completely contrary to the track record of history with regard to UK corporations. What we have seen, particularly for the last 15 or so years, has been a situation where the UK resident company has been taxable upon its worldwide income. Now that means that basically if it had a branch overseas, then it would be taxed on the profits of its branch overseas. If it had subsidiary companies that were outside of the UK, and a subsidiary company is a company in another country which is owned by the UK company, then when that overseas company brought its profit back to the UK, it would be taxed here. Okay, having made full allowance for all the tax that had already been paid on that profit in the overseas country where it has made its money. Unless, of course, it was located in a tax haven, when we had something called controlled foreign company legislation, where if it was deemed that the income in question was basically pure financial income diverted out of the UK to avoid a UK tax charge, then we could actually deem that company to be resident in the UK, and it would in that circumstance actually have to pay UK tax even though it was never here. Now you can see as a result that the UK was quite clearly trying to prevent tax avoidance by UK companies who were moving their income outside the UK to avoid a UK tax charge. And this was part of a complex, intermeshed network of procedures to make sure that we reinforced our residence base of tax. There were 3 components to that anti-avoidance process. One was the residence base itself. The second was the payment of tax on dividends when they were received. The third was the controlled foreign company legislation that meant we could deem a foreign subsidiary of a UK company to be resident here in the UK. And the last component was the transfer pricing rules, which said that if a UK company tried to transfer profit out of the UK to a foreign subsidiary which it owned, then that could be challenged in the first instance when the money left the UK. So it could be challenged when it left the UK under transfer pricing rules, when it was in a tax haven under controlled foreign company rules, and if either of those failed, the third part of the process kicked into place, and when the money came back it was taxed upon receipt here as a dividend. So a highly effective mechanism for ensuring that the UK had a comprehensive tax base that meant sure that UK companies could not avoid their obligation to pay tax. Now, most people would think that's entirely fair, and there's a very good reason for thinking that's entirely fair, and that is because the 60 million people in the UK who are resident here and do not claim the use of the domicile rule, a rule which is itself abusive and which is only used by 100,000 or so people, those 60 million people are taxed in the UK on their worldwide income. So I, as a UK resident person, if I have income arising outside the UK, have to put it on my tax return. I'm given credit for any tax that has been paid on that income where it arises overseas, and at that point have to pay any balance of tax owing in the UK. In other words, there's a complete fairness between the real live living human beings, the warm-blooded people like you and me who live in the UK, and the artificial people, the legal companies who are based in the UK. Now that seems to me to be a basis for tax justice, because people and corporations are being treated the same. Well, this situation is changing. The government has made clear that it believes in a territorial basis of tax. A territorial basis of tax has a number of implications. First of all, the controlled foreign company rules are to be revised, making it much easier for income of a UK corporation to be held in a tax haven outside the scope of UK tax. What is more, the government has made it clear that if this situation arises in the future, where then, particularly if it is finance income, that income will only be taxed at 1/3 of the UK corporation tax rate, which will be 24% within a year or two, and therefore an 8% tax rate will apply to the tax haven income of many companies who own subsidiaries outside the UK. Secondly, although the transfer pricing rules are still meant to operate in this case, obviously that's going to be much harder to enforce if it is actually known that the income can be openly and honestly removed to these countries where it will be taxed, but at a very much lower rate. I can't see how the transfer pricing mechanism is going to be as effective in that case. Lastly, and very importantly, foreign branches of UK companies are now going to be free of UK tax. So if a UK company has a branch, for example, in the Channel Islands, then the Channel Islands can tax that branch if they wish, but by the way, they don't. And the UK won't tax that branch even when the profits are brought back. So suddenly we have a situation where branches of UK companies in tax havens are going to fall completely out of tax, which is a quite extraordinary circumstance. Certainly in some situations this will arise. And also the dividend income from overseas subsidiaries of UK companies brought back to the UK has since 2009 been tax-free. That was done, by the way, by the last Labour government, a retrograde step on their part. So this isn't just the Conservatives, but the Conservatives are pushing the issue a lot further, a lot faster and a lot quicker, with this new tax rate confirming that they are basically letting UK companies set up tax haven operations without any real chance of that ever giving rise to a tax liability in the UK. At the same time, the UK has told the three Crown dependencies, that is Jersey, Guernsey and the Isle of Man, that their 0-10 tax systems are not compliant with the requirements of the European Union. Now that's very important. If the UK doesn't support those three with the European Union, then basically they have to change their tax systems to comply with what the UK wants. And all of them are talking about having a territorial system as a result, having taken their guidance on this issue, of course, from the UK government. Now, what they argue is that, of course, actually none of the companies that they incorporate actually trade inside the countries or the islands in which they're located. They're not countries, they are jurisdictions. They don't trade there because they all receive what they call passive income. That's rents or interest or dividends or capital gains. And their argument is, well, these should have been taxed where they arose, and if they weren't, well, that's the problem of the country where they arose, and we're not going to tax them when they're received in these places. The difficulty is that, of course, very many of these things are not taxed, particularly in the UK, where much of the money that comes from into Jersey, Guernsey and the Isle of Man is in turn reinvested. We don't deduct interest at source from payments to companies in these places. We don't deduct tax from the dividends paid to them any more than we do to a person in the UK, and it's very notional at that. Okay, there is a tax charge within the company, but sometimes that's rather small too. We should deduct tax from rents paid to them, but all my information says that inside the Inland Revenue they're not very good at enforcing this rule, and a person who makes application to receive the rents gross very often is paid the rent gross, and this applies to companies in those places, and then does not account later on for the income received. That's also extremely easy to manipulate because UK borrowing costs are offset against that income, and therefore it is very often received tax-free in the UK. That doesn't mean to say it will be received without a cost in the Channel Islands. There might, of course, be the payment of interest to there to offset the cost arising in the UK. That is entirely possible, so some manipulation can take place. And capital gains arising, for example, on the sale of property in the UK are not charged if made by a Channel Islands company and are received tax-free in those places. So suddenly we're creating a situation where it is very easy to see the possibility arising that companies can relocate income incredibly easily from one place to another, claiming it arises outside the location where they are resident, outside that place's territory, which will be the basis for its taxation, but it is not also taxable in the place where it does arise, and is not taxed upon receipt in the place where the company is actually located. And we get a situation where double non-taxation is going to be extremely easy for lawyers and accountants to engineer on behalf of their clients. Now, is that chance? Is that coincidence? I really don't think so. I really think that this is absolutely deliberate. We have a situation where suddenly the lawyers and the accountants who want to create tax planning opportunities for the benefit of either very large corporations based in the UK or their very wealthy clients who have trusts and companies located in the UK's Crown dependencies are seeing a massive opportunity being handed to them on a plate by the current coalition government, the Conservative element of that government in particular, who are providing a tax planning opportunity which is going to be exploited absolutely ruthlessly by the wealthy. What is the consequence going to be? Well, large companies are going to pay very much less tax in the UK, probably meaning that they will overall pay much less tax than small companies as a proportion of their income, and will in fact have the lowest overall rate of tax of any taxpayer in the UK, including very poor people. And the Crown dependencies will suddenly have a new tax planning opportunity available to them to sell to the wealthy, which will flow funds into the UK, but in a way which is wholly unproductive. This is passive income. This is just money flowing. This is financial services. This is not productive activity that is being created as a consequence. Am I worried as a consequence by this change to territorial taxation? Yes. This is not a neutral change. This is not something that is taking place to encourage an efficient tax system. This is not something that is taking place to encourage investment in the UK. This is not something that is going to happen to generate new wealth and new jobs in this country. This is something that is taking place purely to make the rich richer, to make the poor pay the tax which the rich won't be paying, and to increase the wealth gap between rich and poor and the income gap as well. This is an extraordinarily worrying development in UK taxation, and something that has to be understood and has to be opposed, because the UK is joining its Crown dependencies in becoming a deliberate tax haven open for abuse by multinational corporations and by wealthy individuals, and that has to be wrong. Thank you for listening.